Hi everyone, I am Avadhoot and today in this session we are going to consider retirement of partner. This session is our retirement of partner. Now let's see the agenda of this session. In the agenda, we are going to look after what the things we are going to consider in this section. Here, first part is in the agenda, there is a introduction. Next, we'll have to go for the ratios, then treatment of goodwill, which is important part again, and preparation of accounts. In case of retirement of partner, what is it exactly? As a new partner can be admitted in a partnership firm. Similarly, the existing partner can be retired from the partnership firm. It is one of the modes of reconstitution of partnership. There are so many reasons by which the partner can be retired from the partnership firm. The important are, we can say first, that is by giving the notice to partnership firm as well as other partners. A partner may be retired from that partnership firm whenever the partnership is at will. Secondly, a partner can be retired in accordance with the agreement by the partners as per the agreement. And thirdly, a retirement can be done with the consent of all the partners. The retirement can be done with the consent of all the partners. That is most important. Now, in case of retirement, it is a reconstitution. Suppose there are three partners in a partnership firm. One is going to retire, means remaining are two, they can continue the business and they are called as a continuing partners, whereas the retiring partner is known as retired partner. In that case, we'll have to close the books of the accounts, we'll have to value the assets, liabilities, what are the goodwill is there, how it is to be treated, that we'll have to consider. And for that purpose, it's necessary for us to go for the most important part, that is ratios. How the ratios are to be calculated. Now, in case of admission of partner, we were doing the sacrifice ratio, whereas in case of retirement of partner, we'll have to calculate the gain ratio, or it is called as what? Benefit ratio. Gain ratio or benefit ratio meaning is the same. Therefore, while calculating the gain ratio, whenever the one partner is admitted in a partnership, we make the sacrifice. Whereas in case of the one partner retires, means going from the business, we are gaining something more than that, and that is called as what? Gain ratio. Now here gain ratio is to be calculated as new ratio minus old ratio. Gain ratio is equal to new ratio minus old ratio. The ratio, new ratio is generally available in the problem because the ratio in which the continuing partners decide to share the future profits and losses is known as new profit sharing ratio, whereas the gain ratio, the ratio in which the continuing partners acquire the retiring partners share, is called as a gain ratio. It is normally used to write off goodwill created or raised to the extent of retiring partners share only. It is calculated, gain ratio is equal to new ratio minus old ratio. Now, how it is to be calculated? Suppose there are three partners, that is P, Q and R. They are sharing, the ratio is 2 is to 2 is to 1. Obviously, it comes their old ratio. Now, suppose here the Q is retiring one and they decided to share in future. Who is retiring one here? Q is retiring. Therefore, remaining partners, continuing partners are P and R, and they decided to share in future by 2 is to 1. That is their new ratio. Therefore, how to calculate the gain ratio? Our equation is gain ratio is equal to new ratio minus old ratio. New ratio minus old ratio. Therefore, here we can see Mr. P. P is equal to new ratio is 2 upon 3 because 2 is to 1. 2 upon 3. Here minus old ratio 2 is to 2 is to 1 means 2 upon 5. LCM comes here 15, and that's why 3 5s are 15, 5 3s are 15, 5 2s are 10, minus 3 2s are 6. Hence, it comes 4 upon 15. Now, let's see about the R. R new ratio is 1 upon 3. R new ratio is 1 upon 3. Minus old ratio is 1 upon 5. Again here LCM comes 15. 3 5s are 5 3s are 15. 5 1s are 5 minus 3 1s are 3. It comes 2 upon 15. Therefore, their gain ratio is, we can say in short, GR 4 is to 2. That means 2 is to 1. It is to be way of calculating the gain ratio. Now we can say the another example, that is, suppose there are three partners A, B and C. Their ratio, that is old ratio, is 4:3:2. From this, C retires and the continuing partners A and B decided to share in future 4:3. Therefore gain ratio is equal to, we are going to calculate for A, it is old ratio is 4:3:2. Therefore for A, new ratio is 4 upon their new ratio. Here we have to make the change. New ratio is 3:2. Therefore A's share is what? 3 upon 5 minus 4 upon 9. It comes LCM 45. 5 9s are 45. 9 5s are 45. 27 minus 4 5s are 20. Therefore 7 upon 45. Whereas for the B, new ratio is 2 upon 5 minus old ratio is 3 upon 9. Again here 45. 5 9s are 45. 9 5s are 45. 18 minus 15, 3 upon 45. Therefore here in this case the gain ratio is equal to 7:3. In this manner we'll have to calculate the ratio, that is gain ratio and new ratio, old ratio, etc. Now we'll have to consider goodwill. While calculating the profit at the time of the retirement, it is also necessary to consider the goodwill, that is your treatment of goodwill also to be considered. As you know this very well that goodwill is an intangible asset. In case of admission of partner, we have seen the valuation of goodwill. You please go to that particular session and calculate goodwill accordingly. Here the goodwill is to be calculated and the retiring partner's share is to be considered while making the treatment. Now how the goodwill is to be treated when a partner is going to be retired? That is called treatment of goodwill. In this case, first please see, when goodwill of the entire firm is raised and retained in the business. When the goodwill of the entire firm is raised. Therefore here entry will be goodwill account debit to all partners capital account. The word all is most important, including retiring partner. That to be done in an old profit sharing ratio. When goodwill is raised, it is going to be appeared in the new balance sheet. That is most important. After retirement, that amount is to be shown to the balance sheet asset side. Secondly, when goodwill of entire firm is raised and then written off. Very simple. First it is raised and it is retained in the business. Secondly, when it is raised and then it is written off. Now you know the entry very well regarding the raise. Goodwill account debit to all partners capital account in their old profit sharing ratio. Whereas it is written off, the entry will be continuing partners capital account debit, that is should be in their new profit sharing ratio to goodwill. Here in this case, goodwill will not appear in the new balance sheet. We have debited goodwill whenever it is raised and it is written off. We are going to make the credit. Therefore, I repeat, goodwill is raised, goodwill account debit to all partners capital account, and then in that case the goodwill will appear to the balance sheet, new balance sheet asset side. Second part, when goodwill is raised and then it is written off, goodwill account debit to all partners capital account in their old profit sharing ratio, and second entry will be continuing partners capital account debit in their new profit sharing ratio to goodwill account. Here in this case, goodwill will not appear in the balance sheet, new balance sheet, because it is written off. Now third, when goodwill is raised to the extent of retiring partner's share and retained in the business. Goodwill is raised to the extent of retiring partner's share. Here in the first, it is fully open. What we have done it here? Fully. Whereas here, only the share of retiring partner is considered. Entry will be goodwill account debit because it is raised to retiring partner's capital account. We are going to take only the share, and therefore your entry will be goodwill account debit to retiring partners capital account. Now in this case, goodwill will appear in new balance sheet to the asset side. That we have to keep in mind, that is the share of the retiring partner. Next, when goodwill is raised to the extent of retiring partner's share and then written off. It is raised and then it is written off. Then in that case, goodwill account debit to retiring partner's capital account that we have seen just now. The written off, the entry will be continuing partner's capital account debit to goodwill account. Goodwill debit, goodwill credit. Therefore, it will not appear in the new balance. Here in the first two entries we have seen full amount of the goodwill, whereas here only the retiring partner's share is to be considered, and whenever the continuing partner's capital account is to be debited, it should be at gain ratio. That is to be important. And lastly, we can say in case goodwill already appears in the old balance sheet, then that will be considered as your normal regular asset. You have to consider the appreciation, depreciation, and that effect is to be considered towards the profit and loss adjustment account or revaluation account, or it is to be adjusted towards the partner's capital or current account. This is called the treatment of good. Now we'll have to consider how the accounting is to be done. As per our agenda, it is preparation of account. What the accounts will have to prepare, how it is to be written, that we'll have to consider. Whenever the problem is there, we'll have to go that first we are going to prepare, we'll have to open revaluation account just like in admission of partner, or it is also called as what profit and loss adjustment account. Then capital oblique current account. In case of fixed capital method, we'll have to calculate open the current account. In case of fluctuating capital method, don't open the current account, only let open the capital account. Then after retirement, you have to open the balance sheet, that is after retirement of a partner. Then these are the compulsory accounts, you have to open it, whereas these accounts, that is cash or bank account, goodwill account, that should be shown as a working note if it is not compulsorily asked to prepare, and retiring partners loan account if it is necessary. Why it is necessary? Because if it is told to prepare the loan account when we are going to transfer the amount payable to the retiring partner to his loan account, then it is to be considered. Otherwise, no. Therefore, the accounts preparation is the most important part in our day-to-day account. Revaluation account is just like as a for our understanding purpose, profit and loss account. We'll have to debit depreciation, losses to revaluation account. Appreciation is to be credited to the revaluation account or profit and loss adjustment account, and balance sheet will have to show. For example, if it is given, suppose machinery is there and it is to be depreciated by 10%, it is 10,000, we are writing to the balance sheet asset side, less depreciation, it is 1,000, 10%. Outer column we are showing 9,000, and this 1,000 goes to the profit and loss adjustment account via debit side. That is depreciation. Then appreciation means increase, that is your profit, that goes to the profit and loss adjustment account. After doing this adjustment, before that, it is necessary that we have to transfer the general reserve or accumulated profit to partners capital account or current account in their old profit sharing ratio. In case of accumulated losses, if any are there, it is to be debited to the partner's capital account or their old profit sharing ratio. In other words, general reserve given, that is to be taken to the partner's capital or current account credit side in their old profit sharing ratio. If P&L account is there to the liability side, that is to be credited to the partner's capital or current account, it is accumulated profit. And if P&L balance is shown to the balance sheet asset side, accumulated loss, that should be transferred to the partner's capital account in their whole profit sharing ratio to all partners and to be debited. After doing all the adjustments of the appreciation, depreciation of the assets, then go for the goodwill. Calculate the goodwill and make the, as we have seen, the treatment of goodwill, we'll have to do it. Then close the profit and loss adjustment account, transfer the balance, either profit is there to the partner's capital account credit side, all partners. If there is a loss, then transfer to the partner's capital account debit side or current account debit side to all partners in their old profit sharing ratio. Then close the partner's capital account, partner's current. In this case, first we have to close the retiring partner's capital. The balance of the retiring partner capital account is to be transferred to there by making the payment of cash or bank. Suppose it is the partner's capital account and suppose B is there, partner who is a retiring one, then in that case his credit side total is, suppose we can say 10,000 and debit side is only 2,000. Therefore, there is a what? Balance of rupees 8,000. Now, this 8,000, if we are going to make the payment by way of cash, we'll have to write here bar to cash and the cash account will be credited. It is to be credited. Therefore, first do that one. Suppose partly it is given. Then in that case, suppose out of the 8,000, 2,000 paid in cash and 6,000 is transferred to the loan. Then to loan account 6,000, to cash 2,000, that goes to the cash account credit side, whereas loan goes to the balance sheet, your liability side, as B's loan account, because partnership firm has to make a payment to Mr. B. That is 6,000, that goes to the balance sheet liability side. Therefore, it is necessary for us to close retiring partner's capital. Isn't there? Next, close A's account and C's account. Okay, balance to be transferred and that to be transferred to a balance sheet liability side. But suppose whenever we are going to make the payment or total, we are going to make the loan account instead of cash 8,000 of Mr. B, that is to be loan account, you can directly transfer, no cash entry will be there. Then entries will be, keep in mind, retiring partner's capital account debit to loan account in case of total amount transferred to loan. If it is there in this manner, partly loan and partly cash, retiring partner's capital account debit to bank or cash account and to retiring partner's loan. That will have to keep in mind. There is another thing is that a new partner decide to adjust their capital. When a continuing partners decide to keep their capital balances in their new profit sharing ratio, then in that case the excess capital to be returned or transferred to their current account or their loan account, and deficit balance is there, if any, is to be bought by that partner in cash or transferred to current account or loan. That is to be kept in mind. Afterwards, you will have to close Goodwill account if it is opened. After doing the partner's capital adjustment, close the cash or bank account. Transfer balance to the balance sheet. If any retirement partner's loan account is there, that is to be transferred to the balance sheet as I have shown you. And lastly, after you have to confirm that I have closed all types of accounts, working note, whatever prepared, all these I have closed it, and then close your balance sheet of the continuing partners, and that balance sheet must tally, then it is called as retirement of partner. This retirement of partner is also important for the examination point of view. Here in short I have given regarding the retirement of partner. If you like this video, please like, share and subscribe for more videos. Please put the icon. You will get updation for the new videos. Thanking you. All the best everyone and goodbye.